In this video from accounting101.org, we're going to talk about Section 279 and a few other sections that deal with interest disallowance. Now, because interest paid on debt is deductible and dividends paid on equity are not deductible, a lot of taxpayers try to structure their capital with large amounts of debt relative to the amount of equity. So they'll classify these instruments as debt, but in a lot of cases the instruments look or smell like equity, or they might even be converted to equity in the future. So Congress has taken steps to eliminate these type of instruments, or at least try to minimize the deductions that are allowed to these types of instruments. So a few of the sections that deal with these instruments. Section 279 deals with junk bond interest, and what this does is it disallows annual interest in excess of $5 million on corporate acquisition indebtedness if there's four considerations. First one is if the proceeds are used to acquire another corporation or 2/3 of the assets of another trade or business. The next one is if debt is subordinated to trade creditors and unsecured debt. And then if debt is convertible into equity of the corporation, or if the corporation's debt to equity ratio is greater than 2-to-1 on a tax basis, which is very common in these closely held corporations, or the projected earnings do not exceed 3 times the total annual interest to be paid or incurred. The next section, Section 163E and Section 163I, deal with AHYDO rules, which stands for Applicable High Yield Discount Obligation. This disallows interest in excess of the applicable federal rate plus 6% if the debt obligation has a maturity date that's more than 5 years in the future, if the yield to maturity is more than the AFR rate plus 5%, and that's based on the date of issuance, or if it has significant original issue discount. Section 163J deals with earnings stripping. This says that if the interest that's in excess of 50% of adjusted taxable income is deferred, if the corporation's debt to equity ratio is greater than 1:1, or if the creditor is a related party, and that makes sense, or if the creditor does not pay U.S. tax on the interest income. This would generally be a foreign entity that's a parent of the subsidiary. Section 163L deals with paid-in-kind interest, or PIK interest. This disallows interest on disqualified debt if the debt will be paid off in equity, meaning the debt is converted to equity, or if the debt instrument payoff will be calculated based on the corporation's equity value.